Hey everyone, today I want to go over with you an article that I read called Predicting the Housing Market is Easier Than You Think. This article, step by step, goes through the data points that you would need in order to assess a market, possibly predict it, and I think this could be really useful for those who are data scientists looking to build out models for predicting house price moves. My name is Ariel Herrera with the AnalyticsAriel channel, where we bridge the gap between real estate and technology. Now, if you like insights on data and real estate, then please subscribe so you don't miss out on the latest content. As well, like this video so I know you want to see more of it. All right, let's get started. What we're going to do is go over the article, and I'm going to touch on some really great points the author makes on pointing towards data sets that you could use to actually forecast as well as monitor trends within a market. This article was written on the Medium, and if you're unfamiliar with that website, it's really useful because a lot of experts as well as professionals contribute for free on this site, and you get a lot of great data, particularly for data science. So if you're looking to get into the data analytics, data science, data visualization space, then I highly suggest for you to get a subscription for the Medium. So in this article, what the author is doing is they're basically saying, hey, the housing market does not collapse overnight. There's usually factors that contribute to it, and we can take those factors and actually predict the housing market on our own. Now, while I don't agree that you can predict the housing market as a whole, and if it's the same for all markets, because real estate is so localized, I do think the author makes some really good points to at least spot trends. So they break this article into different steps, and in the first part is looking at some leading indicators to help predict future price movements. Here they look at building permits, housing starts, and new home sales. Now this information can be found publicly, so if I look at building permits, we could see it's on the Census Bureau. You could download the Excel file in order to view this by states and regions, and you could go down to more granular like state, metropolitan, and county. But of course, we'll touch on a later video of how to get this programmatically, since it wouldn't be that much fun to juggle many Excel files. So in this part, it looks like the author was able to get this information and also chart this really easily so we could see how these trends correlate with one another. We could see that permit starts and sales are pretty correlated. Moving on to step number 2, use the stock market as an indicator. So investors use global stock markets to express their view on real estate and housing sectors. And this is when the author brings in S&P 500, which if we click here, the S&P 500 is available on MarketWatch. However, I think if you want to get this on, say, historical basis, it may be easier just to get it from Yahoo, because here you download the CSV file, but with Yahoo Finance, you could actually get it programmatically using Python. And if you use the package Pandas, even easier. So the whole idea here of bringing in this S&P 500 index, which is comprised of top 500 US companies, is that if investors think that the US housing bubble is about to burst, then they will start to sell or short stocks related to the American real estate and housing market. The author then mentions previous events such as the tech boom and oil crash as to when the S&P 500 trended downwards. And the author then goes to further state that if the housing market performs poorly, it doesn't mean that the S&P 500 moves in tandem, so don't expect that to happen. And it says also to try to track XHB, which is an exchange-traded fund to track the stock prices of home building companies within the US. Found that pretty interesting because I wasn't even aware of that prior to. Then in step 3, the author goes into assessing the market's liquidity by looking at the 2-year, 10-year US government bond spread. This part I'm not as clear as to where they are getting the data from, but I'm assuming we'd be able to extract this publicly if we'd wanted to. Step 4, analyze housing-related commodity prices. The author then brings in lumber price. In order to build houses, we need lumber, And the expectation here is that if there's a decrease in construction demand, prices have to fall to counteract excess supply, which we've seen lumber price increase very rapidly in 2021, as well as the house pricing index. The author calls out some features here: yield curve, home builder stocks, REITs, lumber prices, where they currently stand around the year that this article was made, and then whether that's a negative outlook or not. The author then concludes by saying how you can speculate without actually owning physical assets, meaning how you can invest in real estate investment trusts without actually owning the real estate itself. Not sure if they're trying to promote something here, but it is something to note. And then they conclude saying that there would be a housing market crisis, which we didn't really see between 2018 to 2021. So it doesn't mean that this is inaccurate. I believe that the real value here is being able to see what were some of the features, the data points that were used in this analysis, whether the analysis came out right or wrong, and seeing how we can actually use that in the future for our own modeling. So in the next episode, I'm actually going to show you how to programmatically get data from FRED, which is a Federal Reserve economic data source, so that you can build your own model or analyze your market using Python. If you haven't already subscribed, please do.